All right, now, warnings. And this is very serious, and it drives me up the wall. This is Derek's opinion. This isn't to throw shade at any other product. We could just as easily sell what I'm about to talk about, but the warning I'm going to give you is on IULs, Index Universal Life products. They're the number one sold product right now. They make a ton of money for life insurance companies. Is there a use for IUL products? Absolutely. I talked to some agents. I talked to an agent once. He used it for an estate planning practice. The people are already older. Absolutely. I'm not saying there's zero use for them. What I'm saying is if you're trying to do what we're doing with our whole life policies, that we're making our money so efficient that we're creating our own banking ecosystem, and that we're building legacy we could pass down. We can get policies on our kids, our spouses, and that can be cross-generational all the way down. If you're trying to do that, I would not do an IUL policy. And the reasons are very simple. Whole life, you have guarantees and you know exactly what you're getting into. Now, whether you have a bad policy or a good policy, you know what you're getting into. So what I do, and the only way I can really show this is when we compare apples to apples. So I've had clients, we have clients that have had IULs, or they're talking to an agent, so they had some numbers, and we compare, we read through the illustration and what it says. As you get older, most of these companies, they can change your premium. They can increase your premium. That's a massive thing, because we want to live long lives and live into our 80s and 90s. Well, what if they raise our premium so high that they start dipping into our cash value, which we're supposed to be using, right? But if you use it with IUL, you can still take loans, but it's a totally different setup. And if you have loans with that, your money's not exactly working in the same way and the same efficiency that we're doing with our whole life policies. But if your premium goes up, your cash value could be used to pay the premium. But what happens if you're, 85, 90 years old, your cash value is depleted, and you get a letter from the insurance company saying, all right, Mr. Jones, you're paying $2,000 a year, or you've been paying, maybe it's gone up to $5,000 or $7,000 a year, but look, you're out. We need a $20,000 check to keep this thing alive for next year, if you want to get your $500,000 death benefit. Well, now you're jammed up. And what I hate is that people's policies are imploding. Now, we can go back to those variable universal lives. That there's periods of time, like in the 80s when interest rates were real high. These life insurance agents were selling these things like hotcakes, and they were illustrating the paperwork that they give you to say, oh, look what this is going to do. And they were illustrating these crazy interest rates. Well, if you're compounding at a very high interest rate, I don't care what you do. For 30, 40, 50 years, it's going to be huge. But then the interest rates dropped. Then there were issues. There are market issues. Back of the variable, you can lose money. There were market issues. A lot of those policies, fast forward 20, 30 years, are starting to implode. And this is all information that you can access. The IULs, the Index Universal Lives, as best I could tell, they came out about the late 90s. You're talking less than 25 years ago. And I'm afraid these policies could also implode because the costs are going up and the policies aren't producing what the agent showed them on the paper. And the agents aren't bound. You can't go after the agent and say, oh, the paper is different. That's not how these work. There's a lot of fine print that says the life insurance company can increase all this stuff. And let's show you some news articles. And instead of reading it, I'm going to go ahead and show you. Take a look. goes on, and these are big deals. The regulators are starting to figure this stuff out. So the good news is, and we've done these before, there's what they, under insurance rules, you can actually transfer into another policy that's called a 1035 exchange. The 1035 exchange is taking cash value that you've already accumulated, and then if you start a new policy, they'll bring it over to the new policy and they'll close the old policy. Now, I am not saying to go ahead and do that. Every single situation needs to be looked at. So I'm not saying everyone needs to switch over and all this stuff or freak out. I think it's best to have a conversation about it. I'm happy to do that. You're not obligated to, of course, but that is a way out if you feel like you got kind of bamboozled a little bit. The other thing is, look, if you want to know more about our whole life insurance policies, or what we call our cash flow accelerator, and we have a whole network called Bankonomics that we're teaching people that are our clients how to use these things. Feel free to hit the link below, or at least type it in. Go to the site. You can schedule a call. You can watch some videos. And we are happy to talk with you. At the end of the day, this isn't for everybody. We just want to help folks. This works really, really good. It complements investing, especially real estate and other investments, very well. So all that said, I wanted to give you this overview. If you have questions, please put them in the comments. I do check these comments. I'm happy to engage with you. Even if you disagree, a lot of people disagree on this stuff, and that's great. I love talking to people that disagree on it, and we'll go from there. Have a great day.